Back in November 2022, the board of directors at Bed Bath & Beyond signed off on an $11 million pay package for their CEO, even though the company was already telling investors it might not survive the year. 4 months after that check was cut, the business officially filed for bankruptcy, which resulted in 65,000 people losing their jobs while shareholders watched their investments drop to zero. The vendors who supplied the stores were left holding the bag, often getting back just pennies for every dollar they were owed. What you are about to hear is the full story of how a company handed out millions to the people at the top while the entire ship was sinking. Warren Eisenberg and Leonard Feinstein started the company back in 1971 with a single shop in New Jersey that sold linens and bath towels at a discount. Their idea worked because they kept their prices much lower than the big department stores while offering a variety that most competitors could not match. People genuinely liked shopping there because it felt like a place that had already thought of every single thing you could possibly need for your home. If you remember walking through those front doors and grabbing one of those oversized shopping carts to navigate the aisles stacked from the floor all the way to the ceiling, you know exactly the kind of store it was. There was almost always a bin near the entrance filled with those iconic blue and white coupons for 20% off a single item, and most people kept those coupons in a kitchen drawer for months at a time. Many stores would even accept them long after the expiration date because the staff knew that was often the only reason people were coming in. The business grew rapidly throughout the 1990s, and the word "Beyond" in the name turned into more than just a clever marketing slogan. They started adding massive new categories like furniture and kitchen gear, and they eventually bought out buybuy BABY to capture the parents' market. At the very height of their success, they were operating over 1,500 locations across the United States and Canada, which is an incredible footprint for a brand that started as a small local shop in New Jersey. The numbers looked strong during the 1990s and the early 2000s because revenue was climbing and the stores were constantly buzzing with activity. If you were moving into a new apartment or shopping for a wedding gift, Bed Bath & Beyond was likely the first place that came to mind. Their bridal registry business was a particularly strong driver because it brought in a steady stream of new couples who would eventually become repeat customers and build long-term loyalty to the brand. The first real cracks in that foundation started showing by the middle of the 2010s. Amazon had been gaining ground for years, and home goods like blenders and bedsheets were exactly the kind of items people felt comfortable buying online without needing to see them in person first. The leadership team watched this massive shift in consumer behavior play out in real time, but they mostly chose to stick with their physical store model instead of building a digital platform that could actually compete. They were not the only retailer to make that mistake, as plenty of established chains failed to realize how fast the world was changing around them. The situation was made worse for Bed Bath & Beyond specifically, because the in-store experience was starting to feel cluttered and overwhelming rather than exciting, and that famous coupon strategy was slowly eating away at their profit margins every single year. The company was essentially subsidizing customer visits through discounts while quietly bleeding money behind the scenes. By 2018, store traffic was dropping and revenue was trending in the wrong direction, but the people in charge kept relying on the same playbook that had worked 20 years earlier. The business was not completely dead yet, but the window to turn things around was closing much faster than the board of directors wanted to acknowledge. In 2019, the board decided it was time for a change at the top because sales were slipping, and the old operating model was not producing results anymore. They recruited Mark Tritton away from Target, where he had built a strong reputation for developing private label brands that resonated with shoppers. The board believed that if he could make Target's in-house brand successful, he was the right person to revive their struggling retail chain. Tritton arrived with a very specific plan that looked compelling on paper, but did not translate well to the store floor. He decided to remove the famous name brands that shoppers had trusted for decades and replace them with cheaper private label products that the company owned outright. The logic was straightforward because it meant better profit margins and less dependence on outside suppliers. The problem was that the people actually walking into the stores hated the change. Customers would come in looking for a specific Cuisinart toaster or a KitchenAid mixer they had seen online, only to find an unfamiliar store brand sitting on the shelf in its place. Because the product selection had shifted so dramatically, foot traffic declined further, and online reviews took a turn for the worse. The brand had always been known for stocking every gadget a person could possibly need, and suddenly the stores felt like they had less of what people actually came in to buy. While things were unraveling on the sales floor, the company was also making financially questionable decisions with its available cash. Between 2019 and 2022, Bed Bath & Beyond spent over $1 billion buying back its own stock in an effort to support the share price. Stock buybacks are not always a harmful move, but executing them aggressively while customers are leaving and debt is accumulating is a significant gamble. That $1 billion could have been redirected toward improving their website, paying down loans, or simply keeping the shelves stocked with products that people wanted to purchase. Instead, it went toward propping up a stock price that was already beginning to deteriorate. This was the period when Ryan Cohen entered the picture and changed the narrative entirely. Cohen was already well known in financial circles for his involvement in the GameStop situation, and in early 2022, he publicly disclosed that he had taken a large stake in Bed Bath & Beyond. He began pushing the board to sell off their Bye Bye Baby division and argued for even more aggressive stock buybacks. A wave of retail investors who followed his moves closely jumped into the trade, and the stock price climbed sharply in a short period of time. The excitement did not last long. Cohen sold his entire position in August of 2022, and reports indicated that he and his firm walked away with approximately $68 million in profit from that single trade. Once the public learned he had exited his position, the stock price collapsed and left the retail investors who had followed him into the deal with significant losses. Cohen eventually faced a class action lawsuit from people who claimed he had deliberately driven the price up before selling, though he was never criminally charged, and has consistently denied any wrongdoing. Mark Tritton did not stay long enough to see the final collapse. The board removed him in June of 2022 as the financial results continued to deteriorate. Despite the company visibly failing under his leadership, his departure contract included a multimillion-dollar severance payment that was paid out on his way out the door. The same board that had approved his strategy and watched it underperform chose to hand him a substantial check while the company's survival remained uncertain. By the summer of 2022, the company was burning through cash at a pace it could not sustain. Suppliers who had previously extended credit began demanding payment up front because they were concerned about not being paid at all. When a retailer cannot pay its vendors in advance, shipments stop arriving and shelves go empty. And that is one of the fastest ways to destroy whatever customer loyalty remains. There is nothing more effective at driving customers away permanently than sending them to a store where the product they need simply is not there. After Tritton was let go, the board turned to Sue Gove, who had been serving as a board member since 2019 and who understood the company's internal structure. She stepped in as interim chief executive officer in June of 2022, and by October, the board made her role permanent. It appeared to be a pragmatic choice under the circumstances, though it also meant the company was leaning on the same circle of people who had been in oversight roles throughout the decline. What happened next is one of the more striking moments in this entire story. In November of 2022, just 1 month after Sue Gove was officially named Chief Executive Officer, the board approved a compensation package for her worth approximately $11 million. The package combined cash and stock options, and it was presented as necessary to retain stable leadership during a period of crisis. The argument was that attracting or keeping a capable executive in a turnaround situation requires competitive compensation. The timing of this approval, however, is difficult to overlook. In that same month, Bed Bath & Beyond issued what is known as a going concern disclosure, a formal statement in financial filings indicating the company might not have enough money to continue operating through the following year. A going concern. Warning is not a minor footnote. It is a written acknowledgement from auditors that the business is at serious risk of running out of cash. The board was approving an $11 million compensation deal for the incoming permanent chief executive officer at the exact moment the company was formally telling investors it might not survive another 12 months. Gove was not the only executive making financial moves with company stock during this period. Several other executives and board members sold shares during brief spikes in the stock price throughout 2022. While insiders sell stock through prearranged trading plans on a regular basis, the concentration of those sales during a period of serious financial instability drew considerable scrutiny. When the people responsible for running a company are reducing their own exposure to its stock while the business is struggling, the signal that sends to outside observers is hard to interpret charitably. The most tragic chapter of this period involves Gustavo Arnal, the company's chief financial officer. In August of 2022, Arnold sold a portion of his shares just weeks before the stock price fell sharply following the Ryan Cohen exit. Then in September of 2022, Arnold died by suicide in New York City at the age of 52. His death came just days after a class action lawsuit was filed naming him and Cohen as defendants, with allegations that they had worked together to artificially inflate the stock price before selling their own positions. No criminal charges were ever filed in connection with those allegations, and the litigation continued after his passing. But the circumstances of that period left lasting questions about the conduct of multiple people in senior roles. Bed Bath & Beyond officially filed for Chapter 11, bankruptcy in April 2023, and the figures reported at the time of the filing were substantial. The company disclosed approximately $5.2 billion in total liabilities, which included bank debt, unpaid obligations to vendors, and long-term lease commitments on hundreds of large retail locations. Chapter 11 is technically structured around the idea of reorganization rather than liquidation, but there was no realistic path to saving a retail chain that had already lost its supplier relationships and a large portion of its customer base. The filing marked the beginning of a structured wind down rather than a genuine attempt at recovery. The impact on the workforce was immediate. Around 65,000 employees lost their jobs as store closures accelerated across the country. These were not executives with contractual protections or transition packages built into their employment agreements. The majority were store-level workers who had spent years running cash registers, stocking shelves, and helping customers navigate those crowded aisles, and a significant number of them had been with the company for a decade or longer. Bankruptcy law does not prioritize workers in the distribution of remaining assets, so most of these individuals exited with little to nothing beyond whatever final paychecks were processed before the stores closed. For shareholders, the outcome was nearly a total loss. The stock price had been declining for years, but after the bankruptcy filing, it dropped to effectively zero. This hit retail investors particularly hard, including the many people who had purchased shares during the meme stock period when Ryan Cohen's involvement was generating headlines. These were individuals who had put their own money into the trade based on publicly available information and market momentum, and they watched that investment disappear entirely as the company wound down. The vendors who had kept the shelves stocked throughout the company's history were not in a significantly better position. Suppliers that had shipped products but had not yet been paid were classified as unsecured creditors under the bankruptcy proceedings, placing them at the back of the line for any available distributions. Some recovered a small fraction of what they were owed, while others, particularly smaller suppliers who had extended significant credit to a large national retailer, absorbed losses they could not easily offset. The brand name itself survived in a limited form through the bankruptcy process. Overstock.com purchased the Bed Bath & Beyond name and its digital assets for approximately $21 million during the bankruptcy auction. The acquisition did not include the physical stores, the inventory, the distribution infrastructure, or any of the employees. The purchasing company simply wanted the name recognition and the web presence to rebrand its own platform. The physical store network, the buybuy BABY locations, and the entire operational structure of the company are gone. The fact that the full legacy of a brand that operated over 1,500 stores sold for less than twice what its final CEO received in a single compensation package is a useful way to understand the scale of what was lost. The broader pattern visible in this story extends well beyond Bed Bath & Beyond. This sequence of events where executives receive large compensation packages during periods of financial distress is not an isolated occurrence in American corporate history. One structural reason it recurs is that bankruptcy law generally does not require the return of compensation that was paid out legally before a filing date. If the board approved the payment at the time and the proper procedures were followed, that money remains with the recipient regardless of what happens to the company afterward. The people with the least institutional power are consistently the ones who absorb the most damage when a corporate structure fails. Hourly workers, retail investors without legal resources, and mid-sized vendors operating without the leverage of large creditor relationships end up at the back of every line. The $11 million bonus paid to Gove in November of 2022 did not cause the bankruptcy on its own, but it is a precise illustration of who the board was prioritizing when the resources ran out. When the choice had to be made about where the remaining money went, the decision was made to protect the people at the top, while the consequences were distributed to everyone else. If you ever shopped at Bed Bath & Beyond, kept a stack of those blue and white coupons in a kitchen drawer, or spent years working at one of their locations, the story of how this company ended is worth understanding clearly. 65,000 jobs, $5.2 billion in liabilities, and a brand that took 50 years to build, all gone while the executives who presided over the decline walked away financially into it. Thanks for watching. If you want to keep following stories like this one, make sure you subscribe so you do not miss what is coming next.